we will have 3 presentations, one by Olivier, which is mostly theoretical, and then 2 presentations which are related to agribusiness in Brazil and Argentina. And we will organize this session in the following way. First, we will have the presentation during 15 minutes, then I will ask 1 or 2 questions. If there are questions of clarification, you will do this question at this time. Then other second presentation, third presentation, and we will have 30 minutes of collective discussion at the end of this third presentation. Is that okay? So, Olivier, please.
So thank you very much, Félix. Good afternoon to the survivors. So it's the first time that I'm going to present this research about rent, theoretical research, personal research, yes. To be frank, it's not, I have already tried to write the paper several times, okay? But the theme of the rent is really a mess, okay? It's really a mess. And it's the first time I managed to have, let's say, some kind more or less coherent from the beginning to the end. Well, you will have to say that if it is coherent or not. But I'm quite happy to, at last, come to some kind of, let's say, of result, to have something to show about this. So why is it interesting to speak about rent, and especially rent theories today? So we have a certain number of papers that Haila, Birsch, Christophers, and others today, okay, that are speaking about this theme. But we have to say that these are very scattered. I mean, there is not one single argument that emerges, and it's always overcomplicated. Okay, and the question of the link between financialization and rent and the nature and land and all those things is very complicated. And how do we connect all these elements together? Well, and there is also a certain number of very basic problems with the terms and concepts used. For example, rent, well, it means a lot of things, yes? It's something value creation, it's something territorial or urban value. It's also understood as an undue income, which is earned without working or without investing, without any entrepreneurial activity. It's also very often understood as annuities. Okay, for example, if you are retirement rents. Okay, and in English, it is even also used when you hire an apartment, you have to pay a rent, which is not the same in Brazilian, in Portuguese, or in French. Okay, so there is a big confusion about these terms. And it's always difficult to make some order within this. So I stick to the classical understanding of what a rent is. So the very classical, the classical economist says, okay, regarding labor earn wages. Capital make profits. And land, the term rent, is narrowly linked to land or any kind of natural resource, okay, which is given, provided by nature, okay? And of course, there was, I have evoked this morning, during the 40s, there was this discussion among neoclassical economists who said, okay, we no longer need that third factor of production because it's no longer a limiting factor. It can always be substituted. For example, urban land, okay, we have lifts and we can build very high buildings. We have the car and we can extend the city, and so on and so forth. So we don't need any longer the third factor, which is, in my opinion, a very good explanation also of the fact that economics today have problems in order just to think about nature and about the limitation that are very apparent today regarding ores, regarding climate change, regarding biodiversity, and all those elements. Okay, so so it's time to reopen the debate, and my first intention was to say, but there exists no territorial approach to rent theories. Okay, rent theories have always been treated by very classical economists, mainly, also by Alfred Marshall, neoclassical, but somebody who really worked a lot on rent, but territorial economists, very few at the end. Okay, so the idea was for me to elaborate on this paper by Mollard and Pecker, two French authors, that wrote something which was called the territorial rent. And I'm indebted to these authors because I think they did an interesting work, but that asks many, many, many questions today. So, just to begin with, I would like to, my intention is to make something as simple as possible, okay? And to make comparisons between theories. So let's start with basic elements. We have, let's say, here, let's say a region, natural region, a place, okay? And we have land, and we have perhaps forest, and we have a landscape, biodiversity, all those elements that are linked with nature. And of course, economic development needs such objects, okay? And the minimum requirement is that we need at least the place where to stay, where people can stay, where a company can stay, where a machine or a building can stay. This is the minimum natural element that we need in order to have any kind of economic activity. And of course, economic activity means to produce or to innovate or to construct value or to develop markets. It depends, of course, of the kind of economic approach you choose, okay? Schumpeterian is more innovation, production is more about Marxians, and so on and so forth. But what we know is that there is no direct connection between these objects and production. I mean that, for example, let's take land. We have land here, but it's not because we have land that we have wheat production or corn production. In the meantime, we need to have invented agriculture, okay? Petrol is not a natural resource because we need to invent the engine before that petrol becomes a resource, okay? So it means that there is no direct relation between these elements, and that we have all the time in between this famous element, which means technologies, knowledge, representations, and so on and so forth. And this element here is potentially, let's say, infinite. It can develop and develop and redevelop, okay? So it's interesting, for example, Rashal's paper this morning was precisely about that. All these things that are developing here in between. Okay, we have buildings, we have cities, we have all that, we have computers, we have data, but in order to build value and other things, we need any kinds of knowledge in between, okay? So, very basic, okay, I have, so, I will have to accelerate a little bit, sorry. So we have two basic processes. The first is, let's say, resource construction. We have to rearrange existing elements. And the second, which is very important, the work with markets to create value, to find outlets, okay, to interest people and get, of course, some kind of monetary income. This is the basic setting, let's say. But the interesting author here is Schumpeter, because Schumpeter said any apparition of the rent needs two basic elements. First, some kind of scarce resources. Okay, if we have infinite resources like the air, we do not have a rent, but we need some kind of scarcity, okay? And on the other hand, on the market end, we need a high productivity, a high income, new products, and so on and so forth, okay? And the rent appears here always as a tension between these elements. Okay, this is the basic setting. So the aim of the presentation for me is, I will have to do it quickly, to build, let's say, as simple as possible concepts, criteria to compare rent theories. Second, to propose some kinds of understanding of today's value creation processes, because we have historical theories, but we do not have really some kind of synthetic understanding of today's value creation processes. And I would like to end up with what we could call today the urban rent, or urban productive rent, or integrated rent. Okay, so. And the method is to build, let's say, ideal types. You will see, I will show you figures very quickly, just to compare the various theories of rent. So the idea is to fill this table. To have a rent, we need local scarce resources, and we need some kind of value creation. Let's say local scarce resources linked to a place. Let's say global value creation, linked to markets, okay? And regarding territory, we need, I put here 3 categories: monetary flows outside the region, flows within the region, and here the mobility and the capitalization process. I shall explain what it means, okay? And sorry. And of course, I will take the agricultural rent, the industrial rent, the post-industrial rent, and finally the urban rents, okay? So this is Ricardo. Ricardo is very simple. We have a uniform price of wheat, which was growing at his time. And if we look in region and across region, we have differential fertility of land. So if you are lucky, you have a very productive land. Your cost is very low, the price is very high, so you have a rent. And Ricardo was noticing that in London there were many landowners that had a very nice life without working, just because they were renters, okay? So I have to go, and of course we have high national prices and the scarcity of fertile land. Let's shift to Marshall. And Marshall is very interesting because he has an understanding of economic geography. He says, okay, we have the traditional geography of cities and the hierarchy, and we have the industrialization process, which took the form of what he called industrial districts. Okay, industry came here and there in specialized area. And these specialized area were concentrating many companies. And he explained these concentration, specialized concentration, thanks to a concept that he invented specially for this purpose, which is external economies. As we have external economies related to this industry within this region, outside of companies but within the region, then all the companies agglomerate to get an access to these external economies. Okay, today it's a concept that has become of a very wide audience, but it was invented for that purpose. And as you have access to specific resources here, scarce resources, you can develop products that with high price that are sold outside. So this is the industrial rent. It's thanks to innovativeness and competitiveness that it appears, okay? So now more tricky. What is the value creation process today? What are these value creation processes? As I evoked this morning, we can say that we are still having regions with many kinds of local externalities, but it's mostly in relation with this, let's say, symbolic scene that has been developing a lot for the last 20, 30 years, that that value is created today. And I would like to speak about mainly two sectors. The first is, of course, institutional investors, in real estate investors, okay? Because they are in the global city, and because of the opinion they have about such or such regions, they will invest here or there. It's precisely what has been described yesterday by Ludovic and Antoine, this morning also by Mayra this afternoon, or who spoke about that? Yes, several people spoke about this bias that financiers have. These are not bias, or these are bias, but there's a specific representation that make that they work, they put the capital here or there because of their, let's say, opinions, okay? The second kind of people I would like to speak about are mobile consumers, because we have a huge development of the mobility of consumers, And we have a huge development of people that have money to spend without being fixed somewhere. For example, the famous grey economy. In Switzerland, people have more than 20 years of retirement. Okay, during more than 20 years, they are not anchored by a job. So the only thing that matters is where they spend the money. And this rearranges a lot of processes in space. Many regions can develop out of that. And we have many kinds of tourism today. Shopping tourism, cultural tourism, health tourism, student tourism. Well, many activities are turned into experience that require people to move, okay, in order to build the value. And this of course is also a question of the symbolic scene, because if I come to Brazil, there are possibly 1,000 places, interesting places, but I come to Rio because I've heard about Rio, okay, and it's the same for many people. So I have 1 minute less. So these are 3 value creation processes. I go very quickly. I could fill up the table, okay? And up to now, what is interesting is that we have, let's say, a process in 2 steps here regarding capitalization process. Rent theories, up to now, were developed in the following way. You have an income which appears. For example, you have an industrial district that emerged. It brings money within the region, and in the second step, it is capitalized on land, and you can have high rents within the city. Okay, first production, second urban rent. But we have today another kind of development, because we have very large city development projects. And these consist mainly today in first building the city, building urban externalities, and then you have the development of activities, people arriving and all that, okay? This is typical of, for example, in Rio, this is the huge development process around the port, okay? You move all things and you hope that activities will develop, people will come. It's also the kind of Florida type of understanding of development, okay? So the other way around. So I go very quickly. So today the idea is to no longer to have one type of rent of main income, for example, manufacturing or tourism, or to have local services developing. The idea is really to develop integrated cities where all these value chain can coexist without tensions. For example, tourists with local, not over tourism, but to find ways to put everybody inside the city, okay? And the result of this, I go very quickly, is that here something is shifting. Sorry, I go very quickly to this one. So we have a shift. We are going out of the industrial society. This is the last slide. And what we can see is that local activities have a tendency to become global, okay? Retailing, for instance, or taxis, or education. There is a better, yes, can be an attraction factor. And we also have global access to many kinds of activities. For example, scientific papers, scientific debates, you can access them from anywhere. It was not the case 20 years ago, okay? So we do no longer have this distinction between the export base and local activities, which is typical of territorial economics up to now, okay? And this, it means that we do no longer have the multiplier, okay? And this changes a lot of things, so it means also that we have a shift, let's say, from land value capture, which is the traditional understanding of these questions of rent, to, let's say, the financialization of urbanity. I mean by that we have developers that are not only landowners, but they are developers and they're also entrepreneurs, because they build the city in order to get the development of activities downstream, okay? And this changes completely the perspective. And finally, this is my last point. This is just to open, as if it would be necessary to open now, the discussion. I think we have a kind of flat rate capitalism which is developing. There are two sectors in which we have a huge capitalization today. The first one is, of course, real estate, as we know. The second one is the platform economy. We have billions that are of stock exchange capitalization in those domains. And the very interesting thing is that in those two sectors, most of the value is created by, let's say, the customers. I mean, for example, and it's the phenomenon of subscription, of entry fee, all of that. If you come to Rio, you can stay in your hotel room and have a video conference with your friends in your country. Okay, you haven't created any value, but you have paid for the room, you have paid for the trip, you pay for the restaurant and all that. Okay, so the value creation depends on you. If you invest, you engage, you commit yourself in an activity. It's the same for subscription on platform. If you have Spotify, you are not obliged to listen to music all the day, but you can listen to music. You can develop a culture about music and create value. Okay, but it's anyway you will pay the same amount of money, the same amount. So that's why I would call it flat rate capitalism. You have to pay some kind of rent, and then the value which is created depends on you. Okay. Sorry to have been longer.
So as you see, there are many ideas, insights in this presentation and many more in the paper. But unfortunately, we have no time to discuss it now. I will pull directly to the second presentation, except if there is a clarification question. But if not, I would like to invite Lucia to speak, to present her paper now.
Thank you. It's going to be a good discussion because I'm going to apply a kind of Marxist categories to production of value and the extraction of rent. So, okay. So I'd like to thank again Daniel and his team for organizing this seminar. And also I would like to thank all the researchers who participated in our research that I'm going to present today, that was funded by FAPESP and the Université de Lyon. So today I'm presenting the results of our collective research. Most of them, they are here, and they are authors of the book that we are going to publish, I hope. Where is the pointer, please? So, as the Brazilian Urban Financialization School, as we named it previously in Lyon and Phil mentioned yesterday, the entry of several actors linked to the capital market and the diffusion of instruments for financing, valorization, capitalization, and control of real estate production have promoted structural and incremental changes in the process of urban financialization in Brazil. These processes have occurred not only in the main metropolis of the country, such as São Paulo, but also in cities perceived as secondary markets or off the radar by financial investors, often referred also to as medium-sized cities in relevant Brazilian literature, or even as regional capitals, according to our main Institute of Geography and Statistics, IBGE. So we can see these cities on this map, indicated in orange. Sorry, it's not so good. Orange and yellow. These cities are part of the national scale strategy of financial investors, asset managers, and developers who seeks the geographical dispersion or distribution of investments and, of course, of risks. For example, in the first 2 decades of the 2001 century, the main cities in the São Paulo state showed an intense real estate production, especially for residential use, promoting an overbuilding of housing. And I'm going to present the case of Ribeirão Preto, a city situated in the state of São Paulo, is one of Brazil's agribusiness cities and plays an important economic role in the state of São Paulo, ranking at the 10th largest gross domestic product, as we can see here. And despite its economic and real estate dynamism, the city has strong structural inequalities, both socioeconomic and also socio-spatial, marked by a historical north poor people and south rich social division. And then here, we can see some data on it. From 2010 to 2020, almost 80,000 units were launched in land plots, apartments, and houses, which is equivalent to 24% of the total stock of permanent private households. From 2006 to 2021, there was an intense expansion of these subdivisions or urban land plots, totaling 17 million square meters, which transformed rural and or unoccupied land into urban lots. Ribeirão was the second city in the state of São Paulo with the highest number of subdivision approvals, excluding the cities in the São Paulo metropolitan region. In red in the map, we can see the extension of urban occupation during this 21st century. Of this total, the majority went to the low-income segment, as the real estate market considers it, names it, which offers residential units priced within the housing loan limit, with subsidized interest rates, mainly by the Minha Casa Minha Vida program. In the maps, the areas corresponding to these segments are marked by a lighter tone. This production has been carried out by large national companies, most of which are publicly traded, and also regional companies, which are privately held. But, in a paradox, there was also an increase in the number of favelas in the city, that is in yellow in the map. And a good part of the debts of the borrowers of these programs, Minha Casa Minha Vida, in turn were transformed into financial securities through real estate receivables certificates, CRIs in Portuguese. In addition to residential use, logistics warehouses were multiplied along the main highways that cut São Paulo state, and most of these warehouses are part now of real estate investment funds, fees, as well as the main shopping centers in Ribeirão Preto. As we can see in this map, the location of the fees with the warehouses and the shopping in the center, no here, sorry, and also the CRIs created on the MRV, that's the main company, the real estate developer that we analyzed in its production in the city. So in this way, the frontiers of real estate financialization are expanding through the asset portfolios of REITs and also CRIs, and also by the mass production of housing, while at the same time encountering local limits and conflicts. So the extension of these frontiers continues to be linked to the movement of value in the production of space, already identified by various authors of critical political economy, and is renewed today by the combination of process of accumulation and capitalization. I'm not going to explain too much on it, because I want to pass directly to the argument. That is that this process of accumulation and capitalization promoted by actors in the real estate sector in the capital market necessitated two primary spatial strategies. Regarding the mass production of housing, this requires robust local political coalitions, semi-public financing of housing, and production strategies that blend traditional rent gap mechanisms with production management systems evaluated through financialized instruments. This model enables these companies to operate on a national scale while at the same time exerting influence at the local level, thereby professionalizing local markets and impacting regional developers. But this mass production didn't cover low-income families, and land conflicts persist and are escalating as urban occupations and evictions rise in this city. And the second strategy involves the distribution and dispersion of investments and debt securities across the country, such as real estate receivables certificates, CRIs, tied to consumer and corporate debts related to housing production, and also the hits or fees for logistics sector and shopping malls. Both strategies, in turn, enable cities that were previously off the radar for investors and asset managers to enter the investment landscape. So my presentation provides a summary of the primary finds from the research project titled The New Value of Urban Territories, that I said it was founded by FAPESP and the Université de Lyon. And specifically, it outlines the research conducted by the Brazilian team from 2021 to November 23. We used three main methods: field research conducted in Ribeirão Preto, but also with interviews. Sorry, I'm a little bit lost in my pages. Here, sorry. Included in observations, and we made interviews also with stakeholders in the financial and real estate markets involved in managing financial assets with properties located outside the city of São Paulo. And we also employed the analysis of secondary databases, which were produced by private companies. And the third method employed documentary research. And in this research, we used also the cases related to land conflicts to map these conflicts. Then I'm going to present the results. I tried here to resume these results of this research, and we organized this book titled The City in Portfolio. We, of course, made a reference to Christopher's book in order to cover both phenomena: housing overbuilding and also the frontiers of real estate financialization in these secondary cities in Brazil. And here I didn't have time to translate all the chapters, but there are many authors of the chapters here in our seminar. So the first movement we want to highlight is the spatial strategy grounded in large-scale mass production and housing standardization, employed both instruments of valorization and capitalization, and there were some local social spatial effects of this massive production that included changes in land use, shifting from rural to urban areas, thereby extending and densifying the urbanization process, monofunctionality of neighborhoods, increasing in land conflicts and slum clearance, as lower income families were not served by this production, and also there was an increase in household indebtedness among low and medium income families. And this strategy was analyzed, across three primary analytical dimensions: politics, finance, and production. I don't have time to explain all the categories in the dimensions, but in politics we separate the sector level and the local level. So the federal lobbies to formulate housing programs, but also the technical norms regarding building systems, and the local coalitions to change urban legislation in order to increase the urban perimeter area. In terms of finance, we have also finance to production and to consumption. And here, the role of Caixa and FGTS, a para-public funding, it's very important. And in terms of production, we analyze in terms of actors, from local landowners, national real estate developers, local real estate developers, and all the strategies that they employed to produce value, but also to capitalize land rent and also within the debtness of the companies, the ownership of money. And all in this process of construction, we could identify some financialized valuation instruments as net present value to control construction costs and others that I don't have time to explain, unfortunately. And the second movement that we analyzed is from housing to debt securities. And then we can see for this real estate financial investment to be possible on a national scale, particularly in these cities like Ribeirão Preto, the spatial strategies involve diversifying or spatially dispersing asset portfolios to dilute the risks of operating markets considered off the radar. In the case of housing, as I explained, it was a complex rent extraction system that links the production and consumption of housing. And a paradigm, an example is seen in the case of MRV, one of the largest publicly held developers in the country. I'm not going to develop on this because tomorrow Marlon is going to explain this, I think. And the third movement, in the case of commercial real estate, the spatial strategy considers not only diversifying or spatially dispersing asset portfolios, but also prioritize specific segments. So we have here dispersion in terms of geography, but also a specialization in some segments, namely logistics and shopping centers. For the logistics segments, the financial investors consider the proximity to large urban centers, highways, and the previous concentration of warehouses, as we discussed in the previous sessions. And for shopping center, the proximity to cities that concentrate consumer demand. So they use a regional scale of analysis. And these criteria differ from those used for properties in core markets, like in São Paulo, where the intra-urban scale is fundamental. The street of the building address and even the floor number matter when making a decision, as corroborating here the work of Daniel and Mayra in previous works on REITs. And so when analyzing the city of Ribeirão Preto, the research identified 4 properties owned by REITs, 3 of which were logistics, warehouses, and 1 a shopping center. And the main instrument of capitalization in this case was rental income from commercial areas. So in terms of final considerations, in the extension of the frontier of real estate financialization, the instruments for capitalizing rents, land, real estate, and financial, and also financialized valuation are increased without losing the basis of the production of value, which in the case of construction is based on increasing control over the exploitation of labor on the building side. On the other hand, financial speculation materializes in the overbuilding of the social market housing, which in turn does not necessarily correspond to real demand. It's worth remembering that housing needs are concentrated among the lowest income families who are not served by this segment. Land conflicts continue to deepen and precarious settlements continue to grow. On the other hand, speculation packages property and debts into financial assets, facilitating geographical expansion and extraction of rent differentials on a national scale. And in terms of our future research agenda, we aim to apply the framework of analysis based on spatial strategies and social spatial effects, involving politics, finance, and production to investment vehicles such as HITS and CRI. Thank you, and sorry for being a little bit.
I had prepared 3 really nice questions for each presentation, but it seems that my colleagues don't want my question. So we will pull to the 3rd presentation, and maybe I will have time to make 1 question at the end of these nice presentations.
Hi everyone. Well, here I am again presenting. So this presentation is based on a work in progress of a paper we're trying to build with Beatriz. While in our previous research we focus on large developers in our respective country, this paper is based in 2 interlinked smart real estate firms that evolved into becoming some of the largest business groups in each country. Plus, their CEOs and families became some of the wealthiest families in the region, appearing every year in Forbes billionaires rankings. So one of our underlying questions was how and what did real estate and land had to do with this. Plus, knowing George Soros' involvement with seed funding, it was obvious that we needed to understand the role of international financial capital in explaining the current success of both groups. Therefore, some keywords of our papers are diversified business groups, international financial capital, and real estate. So, to understand these dynamics, we found inspiration in 4 sets of discussions within the literature. First, we know many papers have focused on the strategy of real estate developers, analyzing the relational nature of developers' actions and their impact on local governance. However, some recent research by proposing welcome nuanced views on the role of developers at the local level have rejected the role of financialization as a driving force. Second, of course, other studies have highlighted the importance of transcalar alliances and the power of international financial capital at the local level. According to many of us in this room, access to financial capital has altered the scale, type of projects, and orientation of urban production, like we heard Ludovic's and Antoine's presentation yesterday. However, while mostly looking at large urban projects and analyzing public-private partnerships in specific cities, fewer investigations have aimed to analyze the impact of financialization on the firms themselves. This sort of gap has made scholars advocate for more comprehensive follow-the-firm research strategies to take into account how the same firm can switch segments, cities, and scales. Here, we aim to understand the effect of financialization on a web of firms called diversified business groups. Third, and in that regard, our concern undoubtedly resonates with discussions on corporate financialization. However, while focusing on shareholder value and focusing on financial versus industrial gains, these studies have mainly come from economics and have been generally insensitive to spatial variations, with, of course, some exceptions. Four, and we don't claim originality in our focus on business groups, there is a long tradition in France, also in Latin America, to study urban groups and what is called family conglomerates. But their focus has been, in the case of some of our French colleagues, has been mainly on Asian cases or how these firms expanding through interconnected activities, mostly in urban areas. So what are exactly these diversified business groups? While the concept is somehow elusive, Coleman and Hikino provide a comprehensive framework defining them as a collection of legally independent companies, interconnected through capital ties, all under centralized control that manages affiliated companies in unrelated industries, generally controlled by family members. For us, taking this perspective meant analyzing the trajectory of a set of firms, tracing several interlinked institutions, stable business partnerships, long-term family wealth, and historical social networks built through generation. So in analyzing these group strategies, we look at the strategies over different spatial scales, the metropolitan, the national, or even the regional, over different segments and sectors, analyzing diversification, integration, including expanding into agribusiness activities, and lastly, over time, changing investors, changing international fluxes, changing macroeconomic conditions, and even changes in government and links with the governments. So regarding the case selection, we have selected to focus on IRSA Cresud Group in Argentina and Cirela Brasilagro Group in Brazil, two interconnected groups within the Latin American business landscape. These two webs of firms exhibit unique characteristics, such as their position as the most powerful real estate firms led by influential and wealthy CEOs. So the paper aims to analyze the specific strategies employed by these groups, portraying them as channels of global capital and exploring their trajectories. Therefore, our argument is that the anchoring of international financial capital in the 90s turned these small firms at the time into diversified business groups. Plus, their ability to attain unprecedented capitalization levels in the real estate sector reinforced their size, scale, and influence within the sector ecosystem. And that through diversification, and this is very key, these groups were able to capitalize on macroeconomic and financial vulnerabilities in Latin America and, let's say, survive a long time.
So, to present the case, situate them in the country's macroeconomic dynamics, highlights the group's consolidation. Tá dando eco? I'll come back. So, highlighting the group's trajectories and business diversifications in connection with their strategies. So in the 90s, as was mentioned before, Latin America witnessed severe economic reforms driven by Washington Consensus, which led to privatization, market liberalization, and foreign investment attractions. In this context, the international investor George Soros entering the region via his Quantum Fund. First in Argentina, through ISA, when Eduardo Eisenstein, the company owner, secured 10 million investment from Soros to invest in ISA, a listed shell company eventually diversifying into real estate. Secondly, via ISA, Soros penetrates in Brazilian market through Cirela and create ISA and Cirela, the Cirela Brazil Realty, a partnership between the two very powerful businessmen, including the owner of Cirela, Eli Ord. So these pioneering sessions of international financial capital pushed to an important business diversification directed link to the mobilization of more sophisticated financial strategy, highly connected with their capacity to structure and capture land and financial rent through its business diversification. ISA transformation including expanding into a corporate real estate venture, especially malls, by acquire undervalued properties like state-owned assets and distressed business. ISA capitalized on cheap global capital, utilizing dual listing and offshore inflows, which reshape the local real estate landscape, marked by significant development milestone. On the other hand, Cirela shifted to luxury residential and profit control of corporate and shopping center developments, along with the financial innovation like Eurobonds and rates made substantial profits. Access to international capital reduced Cirela financial costs. In summary, the 90s reshaped Latin American markets through reform and foreign foreign investments, epitomized by thorough involvement in ISA and Cirela transformation. Their expansion underscore the transformative power of global influx and innovative financial strategy in navigating in volatile economic landscape. So during the late 90s, and now we pass for the 2000 decade, the economic crisis in Argentina and Brazil were somehow offset by the commodities boom, fostering a decade of sustainable growth. In this new context, the consolidations of the real estate groups gain a momentum, but the trajectories diverged in their urban endeavors due to different macroeconomic conditions. In Brazil, Cirela capitalized on the country's booming real estate sectors, going public on Brazilian capital market in 2005, becoming the Brazilian largest property development company. Foreign capital influx feeded aggressive expansion into diverse real estate products, particularly for middle and low income groups, as Lucia showed before. Public finance and subsidies provided by Minha Casa Minha Vida program in 2009 were crucial in this process, with Cirela actively contributing to shaping the program, rooted its nationwide expansion through joint ventures and aggressive acquisition policy. Vinicius previously showed this process of acquisitions by Cirela, and we represent here on some materials from the reports. In contrast, Argentina lacked of private mortgage credit, also faced a contraction in 2008. Argentina lacked private mortgage grade. So Argentina also faced contraction in post-2008 crisis. So ISA shifted its focus to shopping malls and auto management, investing in dollar-denominated ventures abroad, include New York and Israel. But after a decade of growth, both Cirela and ISA encountered challenges, leading them to loss and regional crisis. Cirela, because of that, diversified into logistics and returned to residential expertise, focus on São Paulo valuable areas where she can extract more rents. And ISA start to disinvest Israeli assets and refocus on shopping malls in Argentina. But at the same time, a new business frontier opened up in relation to Latin America's new insertion into the global economy. With the ascensions of agribusiness as the main sector of the economy, both groups were pioneers in exploring new avenues of diversification. Crevoisier, now the owner of ISA, had invested in farmland since the 90s, fueled by Soros funds, and diversify after that to the productions of oil seeds and cereal grains, sugarcane, and meat. In 2006, Eli Orn, the owner of Cirela, together with Crevoisier, founded Brasil Agro. Brasil Agro was the first agricultural company in rural real estate to be listed in the Brazilian stock market, raising $215 million solely based on an investment thesis, since it not owned properties or had a track record by the time of IPO. The name and experience of Eli Orn counts a lot to that. Both companies share a business model, emphasize large-scale, professionally managed rural properties, targeting cash flows and land value appropriation. They diversify products and locations, are made infrastructure investment for maximal returns in the sale of properties. Regional expansions, as you can see in this map, including new areas of agribusiness, so they open also new geographic frontiers as Mato Piba and Bolivia. I'm lost. Structural boosting increase I lost. So regional expansion mitigate risk and enhance the growth perspective. So sum up everything, you can pass. The group's trajectories show a significant expansion and diversification, turn them undoubtedly into regional diversified business groups with complex structure boosted by increased participations on global finance invest. So we consider them active mediators of finance with the accepted conditions of producing financial and real estate assets and capitalizing on them being supported and shared with these international financial investors.
So to conclude, as we said at the beginning of our presentation, we wanted to understand how land and international financial capital had turned these small firms into diversified groups. But our first conclusion would be that by looking at real estate financialization from a follower group perspective, reveals the changing strategies in context of recurrent crises, currency fluctuations, and international capital shifting flows. It reveals also not only capital shifts within the real estate sector, but also capital shifts to others and sometimes are unrelated sectors. It also reveals the need to look at the long term to understand these processes. And finally, the follow the group perspective, as we call it, helps us understand intra-group knowledge transfer and risk management within the group, shifting losses from one company to the next. However, understanding groups without financial capital doesn't help us at all. We saw how global capital has changed these firm structures and sectors. Plus, international capital injections reshaped urban landscapes, creating new entry barriers and amplifying the influence of these groups. Hence, we could also say that it changed entire national political regimes. In fact, although international capital eventually left, the institutional frameworks established endure, attracting national and retail investors. And finally, when looking at specific strategies on how they were able to accumulate in volatile contexts and through crises, diversification was important, as we said. But certainly, certain financial strategies like dual listing, offshore organization, hedging risk from country to country in the region, and the use of innovative financial instruments were really key. So although things have changed in the past 30 years in the regions, these groups have increased their power, increased their diversification, increased their flexibility, three elements that seem to have helped them survive Latin America's volatile conditions. So in a way, I think this relates somehow to the asset manager capitalism versus something Rachel was saying yesterday about other forms of governance that coexist with asset manager capitalism.
Fascinating, thank you for the three presentations. So we have half an hour for the discussion. I will open it by grouping my questions on the two last presentation. This link between rural and urban, right? Or more precisely between agribusiness and urban development. I found the case of Ribeirão Preto fascinating. It is one of the main capital of agribusiness in Brazil, right? Agribusiness is an issue in Brazil, if not a problem. And research on this topic is at the same time urgent but potentially risky. As testified by the exile of the geographer Larissa Miss Bombardier in Europe in the last years. So thank you for this research on this topic. So my first question, Lucia, was about actually these links between agribusiness and the real estate production that you are showing. Because I would like to understand better these links. I mean, are there direct links in the sense that the surplus made in the agribusiness industry is reinvested in their capital? Are are the families, the companies investing in real estate and in financialized real estate in this city. Are there selling land for this construction? So are they using their agricultural properties to make rent gaps and profit through this urbanization in this booming city? Or on the contrary, is there some tensions between this agricultural use by these agribusiness companies and this urbanization? Or is there a more indirect link on the consumption side? I mean, is this production of housing linked to workers that are working for these companies and for the service job in these companies? Yes, it was my question. And for Beatriz and Ivana, there is a process of diversification, right, from real estate to agribusiness, both in Argentina and in Brazil. And in my understanding, it's quite atypical, since usually industrial group are in diversifying in real estate and not the contrary. For example, we have this case of Pirelli in Milan, but we have also a case in Fortaleza that you know well. Fortaleza, a city of the northeast of Brazil, where for instance the family Dias Branco, which is a family of agribusiness and actually agri-food business, is reinvesting in its own city, Fortaleza, in real estate, right? So can you elaborate about this contrary trend? And do we stay in the same circuit, I mean the secondary circuit, the circuit of rent, or is there a diversification in the industrial sphere with this diversification? It's unclear, my question. Okay. Do we stay in an economy of rent with this diversification from urban rent to agricultural rent? Or is this diversification implying activities on the production side in agriculture? It's clear now? Yeah. Okay, thank you. Okay. And my last question for Olivier this time. You showed that in a sense we can relate the finance and the new economy of the presential economy, right, and the experience economy, because they are related to opinions, how these opinions are shaped. And you have a single bubble with a symbolic something, I don't remember exactly, right? But in a book that maybe you know, Boltanski and Esquerre, a book that is called Enrichment, they consider that these opinions are shaped through totally different ways. I mean opposite ways, especially in relation to time. As Rachel presented earlier today, in the financial sphere, it's opinion about the future that are important and that shape the price at the present time. According to Boltanski and Esquerre, in the economy of enrichment, that is the experiential economy, the presential economy, it is a relation to the past that is important and that shapes the opinions. It is because for example, the watch that you studied in previous researches. It is because these famous actors in the 60s had this kind of watch that today it has a value and it is marketed in this way. So it's, and they call it the collection. It's because there is a série that this object, but also this place has a value. It is because it has memory. Even if it's totally reinvented, it is fails, it is, but it is this ratio. So, is it really the same process that constructs the value in these two different spheres, in two different economy? Is it the same value creation process, or are they opposites, as Boltanski and Esquerre argues?
I start? Or Olivier? No? Thank you for your questions, Félix. The first one, yes, we could see that this local coalition is constituted of landowners, local landowners that are traditional families in the city linked to the agribusiness sector, and also local and regional developers. But in this case of regional and local developers, we didn't analyze the structure of capital of these developers, so I don't know, maybe there are other researchers on it, if they are families from the agribusiness, but I do think so. But we do know that there is a strong local real estate market linked to these traditional agriculture sector in the city, and there is no tension between these two actors. They are together in the local coalition to extend the urban perimeter, as I mentioned before, to offer this land bank, previous land bank that was land for agriculture, to the real estate production, especially for housing production, housing building production for both classes, poor and also for the rich in the north and the south, reinforcing the historical social division in the city. And your second question related to the workers. In this research, we didn't made a survey with these workers at the building site, but for in a previous research, we identified that the workers of the agriculture sector in Ribeirão Preto, most of them, they don't live in Ribeirão Preto, they live in a city near Ribeirão Preto, like a dormitory city, that is Sertãozinho. And we also know from a previous research that the national developers, they bring workers from the northeast region of Brazil who were trained in this specific building technology. So but we didn't do a specific survey on the data about the workers.
Okay, well, thank you, Félix, for your questions. In terms, my first reactions was that honestly, in terms of business groups, what's typical and atypical, it's a bit strange for me to understand, in the sense that when you have such a small business community, every single trajectory is in its way very atypical and very different from the others. That was my first reaction. From going from the industrial to the real estate as the typical trajectory, BIA has analyzed cases in Brazil exactly following that trajectory that relate very much with the Pirelli case. But in this case, the story of IRSA and how it developed, it was like small broker, middle class family that had some financial contacts in the 80s and became like a platform for expanding from real estate to farmland, and then to production activities. But for example, when you think about their acquisitions in Israel, they were controlling a TV, several TV channels, pharmaceuticals, technological, so it was like really diversified. So I wouldn't say it's either industrial or services. It's just business opportunities, flexibility, capital, enter and leaving whenever possible. So I think I answered your two questions.
So maybe just to complement and add some things more focused on Brazilian side, regarding this atypical, I would say that we have this strong discussion from the industrial and also from when industrial is the main activity in Brazil, and always since the 50s, 70s, the real estate branch is a form of more or less natural diversifications. And some authors in Brazil say that since we didn't have at that time a more developed financial system, the real estate works as financial system because all the excedents are sent to the real estate. But I think with all this change that you see since the 90s, but mainly in 2000s, we saw not exclusively in Cyrela and ISA, but a strong process of capitalization inside real estate firms. And considering the stabilities of the movements of real estate, they made these decisions of diversify through different kinds of activities. And the second question, the productive, regarding the agribusiness, if they are productive, we had a long discussion about that because maybe Crevoisier and Cyrela had different trajectory, but what we see is that they are in somehow consider agribusiness as a real estate business, but they also develop many agriculture activities. Some of the activities they develop is a part of the process of produce how can I say, a very well developed land to agriculture. Because what they did, one of the directors explained that they consider this development of land as a real estate development. Say they buy a pure land, and then they invest in infrastructure. Sometimes they put some crops to improve the quality of the land and many process. Crevoisier has a different trajectory, but in the end they say we need to have land in different stages for buy in the times of crisis and sell in the time of booms, commodity boom. So it's a business that is really connected with global value chains because of this dynamic.
Okay, so thank you for your question, which is absolutely central to the paper, let's say. Yes, let's say in the traditional vision we have of the productive economy is that the value of things is in the thing. I mean, I will buy a car and I will pay more expensive if it has a big engine, if it has a leather seats, it has blah 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 and all that. Okay. So the value is inside. Exactly the same for a watch, a traditional watch, standard watch. Okay, you have different, they are more or less accurate and that kind of stuff. In the opinion economy today, so the value is embodied in a good. And the way to innovate consists in putting more knowledge within the product. In the post-industrial economy, we have knowledge, but which is about things. Okay, so for example, for Boltanski Esqueré, you have second-hand clothes. It's nice because it saves the planet, because it's linked to a design of the 60s, and it's about, okay? And it's the same about finance. Finance is always a story about what will happen in the future. It's true, it's linked to the future, okay? But it's still a question of opinion building and the question of, and that's why the value is connected between, on the one hand, the thing itself, and on the other hand, what is said about the thing. Okay, this building is wonderful and is financialized because in the future its value will go up because this or that. Okay, so there is a story, and if you believe it, and if the community believes it, then the value goes up. So this is the very big difference. But it's both case, the financier and the experience economy and all that, both are really linked to this emergence and development of the world of opinion, which is linked to this, let's say, symbolic scene. And why is it so? Because during the last, let's say, 30 years, we had a huge technological development, which is the industrialization through internet of the sharing of these debates, sharing of values, diffusion of knowledge, diffusion of stories. And I just conclude now. So different realms, different communities, and if different conventions of value construction, but both based on opinion. And if we look to historically how it developed, the interesting point is that the first profession that has developed intensively internet and electronic links and immediate communication is finance. And we had in 1992 O'Brien, who was writing his books, The End of Geography, because they already had worldwide networks that were sharing instantly the information. And then this opinion sharing processes developed and diffused to other communities, and today it's kind of a generalized way of building value.
Okay, so even if geography ended in 92, is there any question about the presentation? Yes.
Thank you very much for wonderful presentations. I have a question for each of you. So for Olivier, linking to your comment yesterday about real estate being this real asset and less risky, I want to ask you to maybe think more about housing as an asset for extracting rent. Is it different? Is it a different kind of asset because of this consumer commitment being more certain, or maybe for some other reasons? Then for Lucia, I find it amazing how similar the case is with the Romanian second-tier cities. So many different similar aspects, from the involvement of the state in opening up these cities as frontiers of investment, also the phases of preparation, like the preconditions for this to happen. So many similarities. I'm amazed by this. Also the My House, My Life program, also present in Romania in a similar form. And I'm wondering if these cities, these second-tier cities, were opened up usually by the state through housing, or did you see also situations in which private retail opened them up for investment? Because in some second and third-tier cities in Romania, retail is the first development taking place there. So malls, shopping malls, or these big shopping chains, and they become real estate investors and traders. So they buy up land, they open up a shop, it functions for some years, then they sell the land, something else is developed there, and development, let's say, flow happens in their back. If this happened or not, okay? And for Ivana and Bea, I'm wondering why these two companies were chosen in the 90s by the international capital. Thank you.
Hello, thank you. My brain is almost dying, but I have a question to Bea and Ivana. You use the term "follow the group," and and we have like Francis Brill. Yes, okay. Follow the firm. What is the theoretical difference between these two that you propose, follow the group, and follow the firm. Thank you.
Thank you. Thank you for all three presentations. It was very nice. My question is very brief, and maybe Lucia, Ivana, and Bea, you can say. Can we talk about urgent expropriation processes or land grabbing processes in this research? Can we talk about it? There are something like that? Because in Turkey, urgent expropriation is very useful for the state, for this kind of agricultural things.
Okay, quick questions to Olivier. Why do you call it the financialization of urbanity? Because you did not explain the use of that specific term. And then to Bea and Ivana, you did not really mention the political dimension that goes along with the survival of these groups. So how do they manage to survive national political evolutions? And furthermore, can you elaborate if you have, but maybe not tonight actually, because it may be too long, but in terms of subordinate the role of the location of Latin America in the international financial system, how does it matter when you look at the evolution of these groups? It was not really clear to me. Okay, thanks a lot.
Hi, my question goes to Olivier. You hear me? Okay. As Maida said, my brain is also dying, so I don't know if it's just a misunderstanding of mine or if it is an issue of language barrier. Because in Portuguese we have different words for like housing rent or rent that is being appropriated by different types of properties, and you privileged the land rent on your presentation, and I'd like to know if you would use the same thought process of to approach other types of rent to other types of properties as well, not only land rent, so we could generalize this thought process to other types of assets as means of appropriating social wealth from other sectors as extra profit.
Quick. Oh, thank you, Ivana. I'm very happy that we can share the same results in Romania, in second-tier cities. In terms of, we analyze the production of new house. So, we don't have, we don't have data on this process on retail. We do know that the shopping center mall, they integrated portfolios of REITs in these cities. And Kagri, I don't know how to say your first name, sorry. In terms of expropriation, I think our research was concentrated in the urban area, so we could identify process of, we could say, dispossession or spoliation in terms of land conflicts and eviction of favelas that were located in the main axis of real estate valorization or dynamism. So in the when the favelas were in the way for the real estate development, they were removed, linked to the public policies linked to this kind of eviction and clearance of these favelas in these areas that were considered for the expansion of these real estate developments, mainly in the south area of the city that's target for rich, the production of housing for rich people in the city.
Continue. So thank you for your questions. First, the question of risk and real estate. I think I hope that I haven't said that real estate is not risky, or it's real estate is assessed by Financier as a less risky investment. Okay, and this is very important. This is typical of an internal convention of the financial media, and because as Ludovic reminded us yesterday, who evaluates risk of the portfolio of real estate investors? Financial specialist of real estate. So it's a self-constructed kind of convention, and that's how risk is let's say measured in this milieu. Of course, if we look to the reality, look at the crisis of the subprimes, look to what happened in Spain in 2008. This can be very, very risky, of course. So regarding the people that you made an allusion to the fact that people are committed to live somewhere, to live in a house. Yes, but what's going on with people that do not have monetary income? And well, it's what happens in Ribaão Preto. You have informal settlements. That's it. It's not because there is a social need that we have some kind of financial profit on the other side. Regarding the financialization of urbanity, well, I thought a lot about this kind of stuff. It's because the idea basically today consists in saying that most activities, postmodern activities, need some kind of urban substract to develop. Okay, you reorganized the center of Rio. This year, the center of Paris is reorganized for the Olympic Games. This is typical of a value creation process that needs previous investments and subsequent development of activities. So it's for me the typical kind of modern, postmodern value creation process that occurs at a very large scale today, but which needs this conjunction between, let's say, investments in the city production in order to see afterwards the development of activities. So, and the third question, I don't. Why did I insist on land rent, and the link with other kind of lands rents? Okay, if we look to Marshall, he was making a very an important link to a place. Okay, even thinking in terms of industrial production, he was making a link to a place, and he was because his externalities were linked to a specific region. And the idea that, and I think it's a very important idea to stick with the idea that a rent is linked to place, is linked to nature, is linked to land, to the earth. Okay, and of course, people speak today of abstract rents like financial rents, rents about intellectual property and that kind of stuff. I think we should probably think a little bit before thinking it's a rent. It's probably some kind of extra income that can be linked to some kind of monopoly, but not compulsorily to a place, and not compulsory. It should perhaps not be called rent.
Okay, well, thank you very much for your questions. I'll try to be quick. On the why these companies, what we have is information coming mostly from the press and the books and the biographies. What the story they tell is the way they connect Soros with Edelstein and then Eli Horn is personal connections. But the thing is, we know that the Quantum Fund, the Soros Fund, was looking to expand into Latin America. Edelstein was 23 at the time, and they apparently Soros saw like a young, promising guy able to manage $10 million, or that's what the press said. And so the thing was like, he was trustable to manage that amount of money and put it into real estate. That would be the connection. And then the expansion to Brazil was also through personal connections. There is like this Jewish community real estate similarity between Soros in New York, and they actually got the contact with Soros because of religion. Because of religion in New York, he was living in New York. I mean, many stories that connect religion with these types of connections. Mayra, follow the group versus follow the firm. This is something we're trying to theorize, but for us, the firm is mostly focused on the institutional expansion of a company and the company itself, although there is a lot of history of the firms, of course, and families and generations, and the historians know a lot about this, but our emphasis would be on several things. First, the fact that these are a web of firms that are all family controlled, like each member of the family controls one or multiple firms within the web. The multi-sector, and this is very important, the diversification into unrelated and unconnected activities. Not all the time these are consolidated in the same company. What keeps them together as part of the web is the family, and not necessarily the institutional form and the society of a firm understood as traditionally as what from a sort of historical or legal perspective, and that is very important. And the other thing is that here the personal connections and power and capacity and lobbying, all of that is also very important to understand the role of the firm. So, and this is a long debate in Latin America, and there are a lot of historians who are sort of saying that when economic history in Latin America has focused on the firms, actually they should have focused on the history of the main families in Latin America and how they expand in different firms and in different sectors. And so there is a current debate on the firm versus family that I think is important, and we're trying to take like a piece of that. Yeah, could be follow. That's the next paper. So yeah, the group necessarily includes the on the land grabbing process. Definitely this was part of the land rush and land grabbing. There is, both in Brazil and in Argentina, strong regulations on the foreignization of land and sensitive land in the borders and in the frontiers, and how this was necessarily and should have necessarily been mediated by corporations. So it's more like land grabbing through corporate financialization. So yeah, definitely, but we don't want to miss the controlling power of the group in this mediation process. So it's not a Harvard fund just like buying and administrating a piece of land. So it's like an entire logic that works within the group. And in terms of ludo-political dimension, we didn't elaborate, we didn't talk much about this, but we have a set of political strategies that they have followed over the years. These are groups that escalated from the local level to national level and international organizations. They are part of religious communities, international social and community organizations all over the world. But at the national level, they are both very relevant and very significant in the ways they can influence. Like, for example, in the anecdote thing, when Milei became the president of Argentina, he lived 1 month in one of Elstein Irsa's hotels, and he was the first, he traveled with Milei The first trip, they were two CEOs and Millet, and he was one of the CEOs traveling with Millet. But this is not only this government, it has connections with all the governments, local level, national level. I don't want to say that they are super powerful without weaknesses or just show like a straight line of ascendance. They are contradictions, of course, but we can see like some sort of regularities in that sense, in scaling. And in terms of subordinated financialization, this is something, probably you want to answer that? No. This is something we are also trying to elaborate with this mediation from these agents. One of the things that we make several connections. One of the connections is that the subordinate financialization implies in the peripheries a process of continued volatility, change, crisis, international fluxes, and these mediators have the flexibility to work in that environment and to switch. More than like other type of companies or other type of asset managers, for example. They have the knowledge to operate in this, and the financial dimension of the monetary subordination and how they have to deal with these currency mismatches. This is part of the knowledge and the financial strategy they have elaborated over the years to survive during crisis despite changing conditions.
Just to add about subordinate financialization, I think it's important also highlight as this company has special conditions when compared to the others because they have access to cheaper money through these connections with international capital. On the other hand, this is connected with this political support and the advantage they have to influence policies like My Home, My Life. They are part of the committee that, for instance, designed the design of the program, and also they are being benefited for subsidies in the industrial policy in the time that our president designed to reduce tax for industry that have exportation. Very oddly, the real estate sector also gain some tax exemptions, but they have homes that is not exportation product. And one I mentioned the first day, our new industrial policies that are considering housing and infrastructure as a new way to develop industry. So all these factors seems to us that this connections with cheap money and a lot of benefits put them in a very privileged conditions to capitalize on like the immediate production, but also for global worldwide through this in this vulnerability, in these volatile economies.
Okay, thank you very much. We will close this last session of the day. We followed family conglomerates. We territorialized the theory of rent. We explore new frontier of financialization. Today we also analyze the assetization of commercial property in São Paulo. We analyze logistics in Cajamar. We spoke about the forecasting of real estate and PropTech, about pooling, managing, channeling capital in the asset manager capitalism. What we do? Many things, and tomorrow there will be more. So yeah, now we can have a drink maybe. And yeah, goodbye.